Hello, this is the CEO of Weisenbach Investments, and today I'm just kind of going to do a review on interest rate and bond futures, because I've been paying a lot of attention to them lately. We'll look at some spreads, and I'll just give my opinion on the bond markets. Now, really, my opinion of the bond markets is they're completely overvalued and need to start going up. Like, for example, here is a chart of 30-day Fed fund futures, and as you can see, they're down. Obviously, Fed's been pushing down interest rates. They've been trying to do everything they can. Now we have a sign of this trend being broken, and it's right at its support level, and this trend line here is kind of proving itself to be a support around this area. So what's going to happen is it's likely to go down. It won't get much farther than its supporting downtrend trend line, simply because it's broken its downtrend, and institutions and here at Weisenbach Investments, we believe that interest rates, it's time for them to go. Like, for example, let's look at Libor. See, the Libor has already, what is this? This is the wrong. But the Libor seems to have been coming up a little bit. It's come up quite a bit since this is a stock market rally. It's been pretty flat of late. And obviously, the Fed is still pushing down its interest rates, but that can only go so far. I actually think this is supposed to be 1 month euro-dollar futures, but we'll look at it in a minute. The spread we want to look at. Okay, so the spread between the Fed fund rates and 30-year Treasury bonds keeps going down. And it's starting to come up a little bit. Let's look at this. But here's the deal. The Fed is going to push down interest rates as much as possible. And this is the spur of the economy. But they can only push interest rate so low. And financial institutions and traders in these financial institutions are starting to believe that there's no more downside in interest rates, and there's downside in bonds. So what's happened here is bonds have obviously risen quite a bit. Let's just look at the individual chart of bonds. Here's bonds. And they've rallied immensely, and they're showing a V-topping pattern. So that means they would be in wave C of the Elliott wave, but we're not going to get into that right now. So the credit spread has risen quite a bit, and it's starting to contract. So this is a sign that interest rates are going up, which they are. Fed funding raised the banks, so they're going to come down a little bit. But even so, the spread is going to get bigger even if interest rates go down a little bit, because bond prices are still going to have to go down. And they're just reacting to the rise in interest rates. Here's the rise in interest rates right here. The bonds only reacted this much. Now, let's look back at the interest rate. This little movement is not going to count for this sort of movement. No. So, bonds still need to react, and they were down 1.5% yesterday. I still think that's not cheap. Bonds still have a long way to go. And I wouldn't expect much of a support till probably around this 145.16 level. Now you might get some support around here. And you can see why this was a good options play for a straddle, most likely. But you might see just a little resistance around the 148 level. And then the price is going to need to go down. And you probably won't see support till around here, 145.10. And there's not going to be almost any support around 135. There's going to be a lot of support around 135.24. But it's very likely to break this if the interest rates go up. So my current position is I'm long bonds. Long-term bonds specifically. I like 30-year, but let's also look at Euro-dollar futures. Euro-dollar futures, these is essentially deposits, US dollar deposits in a European bank, but ever since with this European crisis and worries, obviously in the 2011 crash, they shot down, and then with the stock market and the good news, like there's a lot of good news that came out of Europe when the stock markets went up. So you get this kind of thing. And then we have some bad movement, bad news coming out of Europe. Markets didn't react, bad economics, such and such. But then we still have this uptrend. So if the Euro-dollar futures are able to break this support level, it's likely there'll be some good news. They'll rise a little bit, but they probably won't get past 99.67. Very unlikely. If they did, and I'll mark that out for you. So if it did get in here, it'll probably stay in a trading range, but it's likely for the price to start going down some. And then if we this is kind of a large breakout against the overall trend, and really the trend's been up, but if you look at it from a year perspective, it's still down. So is this a regression? Okay, good. There's a regression channel. And you know, it's pretty high on its regression channel. It's likely to go down again. And then we have another resistance trend line. It's likely to push the price down. So another thing I like to look at is the dollar. Now it's time for the dollar to increase in value. There's a V-top pattern, and it's starting to go down. So also, it would be a good idea to short the dollar, just from a technical perspective even. And plus, the dollar can only go so far. And we're starting to we're having good economic times, and but this is just a rise in price. We're going to see devaluation of the dollar because of bad economics in the economy. And the last thing is we want to look at, we want to look at a spread between the dollar and bonds. And it's decreased in value quite a bit. Yeah, there's kind of a splitting. So here's the deal. The dollar index and the bonds are likely that the spread is going to tighten. The reason for this, the spread is going to, the spread's going to tighten. The reason for this is dollar needs to go down, bonds need to go down. And they're both overpriced. So I would short both the dollar and bonds, but just for the heck of it, we should put this in. There's two ways I'm going to hedge. Now this sounds kind of contradictory to a lot of people, but Euro futures. Buy Euro futures, and here's the deal. They've gone too far, too fast. They're on a long-term support level. Right around here. Let's see if I still have it. Nope, I don't have it. Let me draw it out for you. They're at a long-term support level. And far away from the resistance level. If you look, it's on its supporting trend line. That kind of thing. But the trend's going to start having to reverse sometime. I mean, the euro cannot completely devalue itself because fundamental information isn't everything. And the euro is likely to stay above the dollar for a very long time unless something really horrible happens that would affect the euro permanently or for a very long period of time. But it's very unlikely that the euro has any more downside potential. So, long euro and then long oil. And oil's kind of correcting itself. I would see some support around this range right here. And then I'll probably buy at 82. It's got to go down. This is the start of a V correction pattern. So it'll likely correct just a little bit, but long-term oil is great. And you can see it's bounced off its supporting trend line, and it came off its resistance. So it's a little farther to go. definitely won't go past 80. There's just no way. I doubt it. I will be very surprised if it hits 75. Okay. Thank you for listening. This is the CEO of Weisenbach Investments. We're a customized financial newsletter company, and we provide short-term trading newsletters primarily, and we also do trade on our own account, but that is not open to the public. If you're interested in Weisenbach Investments, please visit weisenbachinvestments.webs.com. Thank you.